Hello and welcome to RJ Sanderson TV. We're here in June and we've got a new government after the federal election last month in May. Roy, a new government and plenty of issues for this incoming government to work on and to work through.
Yes, Dave, been a very interesting month. It'll be an exciting future to see what happens over this term of government.
What do you think the main issue is confronting Australians at the moment that this incoming federal Labor government needs to focus its attention on?
I think the biggest issue is probably cost of living and the inflationary pressures that are hitting us from all around the world.
Yeah, I think that's certainly a topic on everyone's mind at the moment. We're talking energy prices, we're talking petrol prices, and then, of course, we're talking about home loans, which brings us into our news headlines, because the big headline is, Roy, that we've had another interest rate rise. It's the first time in 12 years that we've seen consecutive interest rate rises from the Reserve Bank. And there you go. You can see that interest rates, after a period of sustained decreases, is now back on the increase.
Yes, and the Reserve Bank is not led by any political party, so they're independent, and I think this has had a lot of media coverage recently, and we'll talk about this a little bit later, but the future is pretty important, what happens going forward.
Just to sort of add context for our viewers at home, the interest rate obviously has an effect on the cost of home loans, and that is obviously passed on to mortgage holders. But why are interest rates and the interest rate so important in the context of the broader economy?
I think what they're trying to do is reduce inflation, and we'll see the inflation rate soon. And the Reserve Bank's target and mission is to keep the inflation rate within a particular band.
Yeah, let's have a look at that inflation rate, because it has increased again, 5.1%. It was above expectations, and I think the Reserve Bank did say that that they think that the labour market is strong, employment has grown, and there's plenty of stimulus out there in the economy that's driving up this inflation number. Do you agree with that synopsis, Roy?
Oh, totally. We're seeing this. I think we're all seeing this sort of inflation rate. You can feel it. Vegetables are more expensive, partly because of floods in Queensland, but a lettuce at $12, this month. There's all sorts of cost pressures, so we're all feeling inflation, yes.
Petrol's the big one for me. I think, suddenly seeing petrol at $2.25 a litre on the way in today here in Victoria, it's a pretty clear sign of the increase in cost prices.
And there's pressure on wages to go up as well. And the government and the referee have said 5.1%. They're all supporting. So the unions and the government have sort of agreed on that. So I expect there'll be a 5.1% minimum wage increase. So the difficult part is, which is pushing which? Is it the horse before the cart? Is it the inflation, therefore you have to increase wages? Or is it wages following inflation? Because both will push each other up.
Yeah, and that's the challenge, as you say. The more money that there is in the economy, the more chance there is of inflation and costs blowing out. So it's a delicate balancing act for policymakers, and the Reserve Bank, as you say, plays an independent role in this, and the government has to work out what their role is going to be in curbing inflation, and the only lever they've got to pull there is interest rates.
Yeah, and if interest rates go up and businesses have loans, then they have to put prices up because their costs have gone up. So it's a very difficult balancing act.
Delicate balance. One of the indicators that we look at every time on this show is consumer confidence. It's usually a good indication of how people are feeling, and Roy, it's been another decrease. So it's the 6th month in a row that the consumer confidence index has fallen. And this is the biggest month-over-month decrease since June 2015, a 5.6% month-over-month fall. Things are pretty precarious at the moment.
And I think this has a number of factors in it. Cost of living and inflation, belief that wages are going up, interest rates going up, worldwide issues. Interesting that it's dropped such a significant amount in just 1 month.
I thought, as a way of giving greater context, Roy, we should look at the Consumer Confidence Index over a long period of time. That's the last year. You can see the last 12, but This is what the Consumer Confidence Index looks like over the last 25 years. Now, you can see some big troughs there. 2008, the global financial crisis. So it's usually a global phenomenon that creates those troughs. And then 2020 was the COVID-19 pandemic. In terms of where we're at, if you remove those two outliers, you know, we're at the downward end of where the Consumer Confidence Index is on a sort of, regular month-to-month basis. So if the Consumer Confidence Index continues to decrease from here, we're almost into a new kind of economic phenomenon.
Worldwide as well, not just Australia-based. So there would be some hope and expectation that that graph will start to peak up over the next couple of months rather than continuing to decline.
Yeah, I think that the challenge for policymakers across the board is to come up with a coherent narrative as to what the future looks like and how we're going to get there, because there's so many opinions swirling around, and there have been for a long time, and there's plenty of loud voices in the room, but there doesn't seem to be a coherent narrative. Are we going this way or are we going that way? And that, lack of congruence there is creating some disharmony in all of these economic situations. And as you kind of spoke about there, Roy, there's competing interests here. There's things that will have detrimental effects regardless of the way that you do. So it feels like now's a time for really rethinking a lot of these things that we've done for a long time.
And I think it's challenging for a new government. And to be fair, it is a new government that's only been in for a blink of an eyelid. So I think that there are challenges here for the new government to set some direction for Australia.
Well, one thing that is perhaps not a challenge, or on paper not a challenge, is the unemployment rate, because it's at an all-time low level and has remained consistently low now for a long period of time. 3.9%. It's at a historic low, the lowest in survey history almost type thing, Roy. So, in one sense, it suggests that there's it's a great outcome. Most of the people that want to be employed are employed, but we're still seeing massive amounts of job advertisements, and we're still seeing a lot of unfilled supply within the business community.
Totally labour shortage out there at the moment, not just in the accounting industry, but on construction sites, in the banking industry, in hospitality, everywhere. Every industry has got labour shortages at the moment. So it begs the question, where is full employment? Because there's a certain part of the population that are going to be long-term, historically unemployed. So are we close to full employment? Because out in the marketplace right now, it actually feels like we might be.
That is an interesting point. As we say, the unemployment rate only takes into consideration the workforce of participants, the people who want to participate in employment. If you are not actively seeking full-time employment, you're not measured within the unemployment rate. So it's in some sense it's a metric that lacks that visibility of that cohort. But yeah, the question is, what is full employment?
Yes, and what government initiative could be put out there to bring people back to the workforce? So maybe some incentives for people who have retired due to COVID or over the last 4 or 5 years to come back into the workforce.
I know you've got some strong thoughts on that coming your way later on this episode. Roy, GDP growth is another important indicator. How important it is at this particular point in time is perhaps an interesting point as well. It doesn't feel like it's the most important of the indicators for once. For the first time in a long time, we're not necessarily focused too much on this growth number. It's 0.8. It's flattish. It's still lower than expectations, but some of the other indicators seem like they're more significant at this point in time.
I feel that any growth is good in these sort of circumstances. We certainly don't want a recession. So small as it may be, any growth is fantastic.
The housing market is a massive issue for the incumbent Labor government, and house prices and unit prices, as per CoreLogic, are still pretty flat month over month, and we can see some small declines in Sydney, Melbourne, Canberra and the 5-city aggregate. That's a few months in a row now that we've seen decreases, particularly in Sydney and Melbourne, Roy.
They're small decreases, and we are seeing and feeling it in Melbourne, but a small decrease is, in my opinion, okay, because we had some phenomenal increases. Still, the year-on-year change being positive at 5.8% in Melbourne and 10.3% in Sydney is still where you'd like to see a year-on-year increase, in my opinion. Somewhere between 6 to 9% is quite good long term. So the month-on-month change is not a surprise, and I'm not disappointed by it. It's levelling out, which is where it needs to be for a little while, levelled out.
So let's just take stock of some of these indexes, because one thing we do want to make clear is that the current interest rate increase only happened a couple of days ago. So that GDP number, unaffected. Unemployment number, unaffected by it. The house prices and dwelling prices, unaffected. Consumer confidence number, unaffected by those interest rate rises. So really, already, we're sitting here anticipating what are we going to be talking about on the next episode of RJ Sanderson TV as the increase in interest rates starts to take more of an effect.
I think our prediction would be that the consumer confidence is going to go down again.
Which as we said, puts it into puts into perspective. The situation is quite precarious. We're at a level that during sort of the normal play-by-play of the consumer confidence index is at quite a low level, historically, outside of the global phenomenon outliers. So it's a really precarious position, Roy, and hopefully we're talking about groundbreaking policy that solved this on the next episode. But I mean, we doubt that.
we doubt that. But we'll see what happens over the next month. It's certainly going to be challenging times.
Roy, tax time is just about coming up again. Can you believe it? You guys must. I know that we mentioned this last year. You've got the streamers ready, the champagne ready for the June 30 end of financial year party, and it's. But by the next episode, we'll be recapping that party as well.
We will be, and for those that are waiting for 1st of July to get your tax return done, historically it's not the greatest time to get your tax return done. At least wait till mid-July when we have data on the computer from the tax agent's portal for things like your private medical cover statements are there, your income statements, or used to be called group certificates, will be there. So give it a couple of weeks. Don't book your account for the 1st of July. It's not practical.
Businesses, you've got some tips for businesses. Talk us through some of these tax tips for businesses, Roy.
Yeah, I thought I'd just throw out 5 quick business tips before we lead into June 30. The first one is if you purchase assets before June 30, you get the full tax deduction under the current regulations, but you must take delivery prior to June 30. That's a little bit of a trap. And the instant asset write-off that I'm referring to does expire on the 30th of June 2023. Your super guarantee, if you're in a business, normally your June super is payable to the super fund by the 28th of July, but you only get a tax deduction for a super contribution when you physically pay the money. So I would suggest that you work out your super contribution and pay it before the 30th of June, but give the super fund at least 7 days to receive it, because they actually have to allocate it to your account for you to legally get your tax deduction. Third point, staff recognition gifts. There's no fringe benefits tax if you spend up to $299 per staff member, so you can give away a gift card, and that's per staff member, gift card for your staff members. So buy those gift cards before June 30 and hand them to staff. And remember that income goes on your tax return based on when you invoice the customer, not necessarily when you receive the money. So think about when you're doing all your invoicing, and if cash flow allows you to not invoice in June, that can help you. And bad debts, don't wait till 1st of July to look after a bad debt or write it off on your bookkeeping system. Bad debts must be written off before the 30th of June in your bookkeeping system. So start looking at those now, because you don't want to be paying tax on income that you've invoiced that you know you're not going to get paid for.
And Roy, the company tax rate, what's the outlook for that?
I thought I'd just share this because the tax rate is currently at 25%, but it's still 30% for companies listed on the stock exchange or for those with turnover over the turnover thresholds. So just keep that in mind, that our current rate's 25%, and that means if you're on a high income and you're paying 47%, if you're on wages, there's not much we can do about it. But if you're in business and you've got a lot of money flowing to your 47% tax rate, if you set a company up, you may be able to reduce your tax rate to somewhere between 25 or 25 or 30%, depending on the type of income. So talk to your accountant, whether it's R J Sanderson or somebody else. If you're on a high income, talk to your accountant about what your options are.
Roy, what about for individuals? What are some of the tax tips as we approach the end of the 2022 financial year for individuals?
I thought I'd just share a quick tip here for individuals. This is a good tip, I believe, because you can put up to this current year $27,500 into superannuation. But you've got to take into account how much your boss has put in. So if your boss has already put in $10,000, then you've only got, $17,500. But in this circumstances, and this slide I've shown, is if you didn't put in enough last year in 2021, so you didn't put in the whole 25 because it was 25,000 maximum last year, then you can carry forward any shortfall into this current year. And I've just given an example there that you can bring forward prior year shortfalls, and you can do that for up to 5 years. So that only got invented in 2019. So work out how much you can put into super, but make sure the contribution goes in before the 30th of June and give at least 7 days prior to that. So you're really looking around the 23rd.
Some great tips there for businesses and for individuals as well. Roy, one of the things we've spoken about on this show is Australia's transition to a digital economy and the importance of that. And the outgoing Morrison government had a number of policies around Australia's transition into the digital economy. And James Hutton is a director at Digital Growth Creative who is helping businesses with that transition into the digital economy. He's been good enough to join us on RJ Sanderson TV today. James, tell us a little bit more about Digital Growth Creative and how it came about.
Thank you for having me on. So Digital Growth Creative is passionate about building websites that achieve results. Generally, we deal with a lot of new businesses that are trying to launch a website. What we identified was a lot of people who try and research websites get stuck and get confused. So we've just tried to make the process a whole much easier.
James, it's Roy Sanderson here. Thanks for joining us. Do you believe that all businesses should have a website?
Hi, Roy. Yeah, so I actually believe all businesses require a website now. It's probably the most important marketing tool you can have in your disposal today. It's mainly because if we think of it this way, if you're looking for a new service like a gardening service or a painter or looking for an item, the first place you're going to go is Google. And if you don't have a website, you're not actually going to list there. So it's really important for businesses to have websites now.
James, a lot of businesses think that the cost of a website is out of their reach, so small businesses tend not to have one. Tell me, what does a website in average cost?
Yeah, so when it comes to building a website, I know a lot of businesses can get scared off because it really depends on what you're looking for. But typically, to get started for a 5-page website, for information and credibility, you're probably looking about $770, and that's including GST. So it's not too expensive, but if you're looking into something a little bit more technical, it can get a little bit more expensive, but it all depends on the purpose of the website itself.
James, I know that there's a lot of small businesses out there that say we don't need a website, we've got social media. What do you say to businesses like that as who are potentially trying to run their business just through social media platforms?
Yeah, so actually there was a recent study that indicated 84% of today's consumers actually think having a website makes your business more credible compared to ones that have social media. So if you're just on social media, you're also then missing out on the fact of Google rankings as well, search engines, and a lot more people are looking for businesses on search engines than they are on social media anyway.
James, I've had some businesses that have set up websites using offshore people, and I've had some horror stories because of it. Are you onshore on Australia? Where are you based?
Yeah, so all of our development is onshore. Same with our actual web hosting services. The thing businesses need to be careful about in Australia is especially around the privacy policy laws. For example, I know with yourself, R J Sanderson, you have an online tax return form where you collect tax file numbers through. So if you're hosting offshore, you've got to be very careful about the type of data you're collecting because you could potentially be breaking privacy policy laws which are set by the Australian government. So it's really important to make sure that you're dealing with a company onshore, especially when it comes to your website and your data.
James, we got you on because I know you look after RJ Sanderson's website, which you do a brilliant job. But what are some of the other websites you've worked on?
Yeah, so I could sit here all day and talk about some of my favourite ones. Some of my favorites are mprecycledtimberco.com.au. We've also done drjihan.com and purecomputers.net.au. But on our website, we actually have a full showcase of websites we've done, and we have case studies going into more detail about the services we've provided them. But yeah, so that they can be found on our website.
Some familiar names there, Roy. I think we've had some of those people on our show over the past few months. Hey, thank you so much for your time today. It's been great to chat with you, James. All the best, and we look forward to seeing where your journey with Digital Growth Creative takes you. Thank you for having me on. James Hutton there from Digital Growth Creative. Roy, as I mentioned, and as James mentioned, it's basically par for the course now for a business to have a website, and it's actually amazing that there's so many businesses out there that don't have one. We do a lot of mentoring for clients and even non-clients that approach us just for the mentoring, and one of the basic things is you should have a website. And James said $770 as a starting point just to have a showcase. In today's world, the website is actually your shopfront. So every business should have a website. Particularly like thinking about how you could generate return on investment from $770. I mean, even businesses with low cost products, it wouldn't take too long to see return on that investment, surely. Yeah, I agree. Yeah, and I think it's digitalgrowthcreative.com.au. So reach out to James if you're looking for a website. Roy, as we do every time on this show, it's time for my favourite segment, Roy's Rage. It's where you go off course a little bit and talk about something that's grating you at the moment. What is it this week? Well, we've talked a little bit about interest rates and the inflation rate, and we know that the Reserve Bank's mission is to keep the inflation rate low, and that's okay. I'm okay with that. And we know it's non-political, so it's not led by Labor or Liberal, and I think that's good as well. But what does the point of increasing interest rates? What is the point of that? It's really to suck money out of the economy. And if it's sucking money out of the economy, it means we're spending less. And the theory is, in economic textbooks, is that means demand decreases and therefore you won't have as much inflation. But if you drill into what's causing the inflation, I actually don't think it's the demand at the moment. And I think the basic economics right at the moment in the world economies is different to what is in our textbooks. Inflation is not being caused by demand. Look at what's causing inflation. It's higher petrol prices. It's increased gas prices. It's a labour shortage. Now, it's materials, it's supply and demand, distribution. There's a war in Ukraine. There's worldwide inflationary pressures. So increasing interest rates, in my opinion, will not have the effect that it would normally have. So I think the Reserve Bank needs to ease up and come out and say that increasing interest rates won't have a big impact on inflation in today's circumstances, and that they need to state that interest rates will stay the same for some time. That's an interesting point, Roy, and I mean we could we could sit here and talk about aggregate demand and aggregate supply and the movement of those curves. But basically, what you're saying is it's not demand, it's not consumer demand that's pushing the price up. It's the cost of supply and the relative scarcity of supply that's pushing the curve up and prices increasing that way. And I think that more broadly, how do we solve it? If interest rates remain the same, we do know that there's a lot of money out there. How do we solve the pressure on prices there? Well, when we increase interest rates, that affects businesses who have borrowed money, homeowners and investors. And in the investor segment, that means rents will continue to be pushed up because they're going up at the moment. So rents will go up. And I just think this is the wrong strategy in today's economics. I know you do have a strategy. What do you think the strategy should be? Well, I think the strategy is that we need more people in Australia. And there's a slide here that suggests how long it takes for a person who lives in, say, England or anywhere overseas to get a visa to come to Australia. We need more people in Australia. We need more visitors. And I believe that this is part of the problem. A working holiday person, it takes 4 months to get approval for 90% of the applicants. But the two at the bottom, temporary graduates and student visas, we need students here, and it takes 8 months to get half the applicants processed, and it takes 7 months to get 90% processed for the bottom one, higher education.
put staff into those areas and get the approval process for visas for people to come to Australia down to something that is somewhere between 14 days and 30 days for all of those categories.
Yeah, it's an interesting solution, because simply increasing wages may have an inflationary effect as well, and you know, that's how you're going to fill some of those gaps in the labour market at the moment with the population currently as it is. If you just increase wages, but that potentially has an inflationary effect. So, you know, opening the population or increasing the population, we've seen that that's been, you know, very adversely affected by COVID, may be a great solution. So an interesting point that you make there, Roy, and I think a prudent point as we move on to our next guest, Andrew Kent, who is the president of the Australian Landlords Association. We've spoken a little bit about, you know, the pressure in the rental market at the moment, and it's great to welcome Andrew to this conversation. Andrew, thanks for joining us on RJ Sanderson TV. It's a hot rental market at the moment. What's your general overview of the market conditions at the moment?
There's three main factors impacting on the rental market, and the number one is demand, and we saw that even during COVID. One of the things that the tenant has in their favour is the flexibility to move. So what we saw during COVID was people were fleeing Melbourne, if we look at the Victorian case, and out to the regions, and so that put up the rents in the regions and decreased the rent in the cities. So demand is definitely the number one thing, but it's not the only one. I've got a couple of slides here if we'd like to share it. So this looks at the change, year-on-year change demand per rental listing. So we can see there that Melbourne's, people are obviously coming back to Melbourne. That's pushing up the demand for rent. When demand goes up, the price tends to go up. So that's one of them. And you can see that some of those regional areas are now coming off. So in terms of demand there. So the other big one, and Roy touched on this, was costs. So when we look at the top 10 costs that landlords incur, the number one is interest on loan. So as the Reserve Bank puts up the interest rates, you can see that, you know, big slice on the right of that graph. It's nearly half the graph is interest on loans as a cost. So if that goes up, they're going to go up. And then we spotted this early in 2022. All of the top 10, 9 out of the top 10 expenses are going up. And the real worry in Victoria is that number 10 one, land tax. So the state government now earns over half its revenue from property. So as we all know that the state government is spending more money than they have done for a number of years, and they've tried a couple of times to put land tax up even more, and that's likely to continue. So we can see that the costs are going up, and so that's going to be driving up the rental. And then the next one is reduced supply, and we sort of go, well, why in such a market when the rents are going up and so forth, and we're still waiting for, you know, Roy was just talking about migration. We still haven't seen the migration come back into the country, and so we'd sort of go, well, why is why is there a reduced supply? So number one part of this is changes in the Victorian legislation. So we're just talking Victoria at the moment, and we can talk more broadly, but I think that most of your audience is in Victoria. So the building standards for tenants exceed normal building standards. So what a lot of, particularly if you've got an older building, what you'll find is that your house is good enough for an owner to live in, and it's good enough for you to sell as a dwelling and someone to move straight in, but it's not good enough for a tenant. And so that is causing people to go, well, I'm not going to go and refit my property to meet these new laws, I'll just sell it. And the other one is that tenants have rights that have increased risk of property damage. So pets, so now that, you know, it's very hard for a landlord to say no to pets. Redecorating, so tenants now have rights to repaint, do some other things. There's limited number of inspections, so the chance of property damage, of not spotting property damage for a while increases. And the make good clauses are often ineffective. And look, the real risk in here, and this is not a new risk, it's not legislation based, but if you get, some illegal activity going on in your house, and obviously that's not the landlord doing that, it's the tenant doing that, that can have a very major impact on your costs. So the other thing is the end of lease notice period is 3 times longer for a landlord than a tenant. So and a number of landlords get caught out on this, that you've got to, if it's a 1-year lease with at the 9-month mark, you need to let them know that that lease is ending. You want another, term to start. And the other one is the price is going to be increased every 6 months. So because you've got limited opportunity as to when you put the price up, they're bigger jumps than they used to be. So landlords are now hedging against these future price increases and so forth, and putting the rent up, because also their property managers saying you can get more. And the other one is tenants are often outbidding each other to try and get the property. So that's all of those have flowed through. And then the other big impact on supply is landlords are exiting long-term rental market, residential market. So what's happening here is they're transitioning to short-term stays. So this is the fastest growing property sector, and this is particularly true in the regions and down the coast. So if you're in a destination, location, then transitioning to short-term rental can actually triple your revenue. And the other thing they're doing is they're just going, it's too hard, and they're selling to home buyers. So they're the 3, key things. So demand's increasing, costs are increasing, risks are increasing, and supply is reducing. So when people sort of try and sort of put this on the landlords, there are 2 million individual landlords in Australia, and most of them are mum and dads, tradies, regular people, and they really don't have any control over the market.
Andrew, I've been a really big supporter of the Australian Landlords Association, and you've done some great stuff. Are you actually actively lobbying government around the legislative shifts to more so against landlords towards tenants?
We absolutely are, and we're having some good traction in other states, because we've been able to point to Victoria and say you don't want to follow Victoria. Queensland is already well down the path of following Victoria in terms of making some of these changes, but in the other states they've actually delayed some of that. The other one that we've had some really good traction on is, and a lot of people don't know about this one, but I know you've mentioned it on here before, Roy, is that interstate landlords are unable to go through the local. So if you own property in Victoria and you live interstate, then you can't go through VCAT if you have a dispute with your tenant or even with a supplier, because the local VCAT is seen to be only for residents, between residents of the state, so it's seen to be out of jurisdiction. So that's one that we've really raised the attention of. South Australia's addressed it, Victoria has addressed it. Well, it's in the process of addressing it, hasn't quite cleared it. We thought it would clear it, but it's actually been delayed. And so that's another one that we've really fought hard on.
Andrew, you mentioned those 4 areas that are creating pressure. If you were to name one as being the most significant one, or your area of focus as the Australian Landlords Association, which one would it be?
It's the legislation. Really, this is a problem generated by the government, because we've got members who have been landlords for 20 years who are getting out. We've got long-term landlords who have been in the residential market who are moving into the commercial market, because they're saying this is too hard. The cost is, like, I'll give you an example. Someone's been renting out a property for 10 years. These new laws have come in, and it requires the gas regulator to be checked. I think it's every 2 years. The gas regulator is located behind the oven, because when the house was built, nobody thought that anyone was going to be checking the gas regulator on a regular basis. So to have the regulator checked, they have to pull the oven out, check the regulator, and put the oven back in. So the cost of doing that is they just sort of go, well, if I sell this house to anybody who's not a tenant, it's perfectly okay. So I'm going to do that. The same with the height of cupboards between the gas stove and the cupboard, or has to be a certain height. Again, I could sell that house to anybody, but I can't rent it out. So what we're seeing is the legislation is just, why do tenants require a building code that is greater than a new build? It just doesn't make any sense.
Andrew, if we have less landlords, then we have much more pressure on rentals, and we know that. And I love the work you guys do. If any listeners are interested in becoming a member, how do they go about joining the Australian Landlords Association?
Thank you, Roy. Great question. We can't do it without the support of the members. So the way to join is to go to our website, which is australianlandlords.com.au. So I'll say that again, australianlandlords.com.au. And it's a very simple process to join there. I'd love to see the members join up.
Andrew, some great insights there today. Thanks so much for joining us on RJ Sanderson TV.
Pleasure.
Andrew Kent there, the president of the Australian Landlords Association, and Roy, it's the housing situation in Australia is dire at the moment, and there needs to be a broad body of work done across rentals, across ownership, across interest rates, as we've talked about. So they're all interconnected, and there's a lot of work that needs to go into that space.
And I think the problems we're having today haven't been created yesterday. They've been maybe a couple of years in the making, because some of the regulations making it harder for landlords, they've been enacted for some time.
I think that one of the areas that Andrew touched on that's important is this idea of the disconnect between the different, legislative powers. And I think that was one of the great initiatives in COVID, was this national cabinet where the premiers and the prime minister all had this, consensus style of national government. My question is, is there going to be any more of that, post-COVID now, with issues like housing that clearly can't be solved one state at a time?
It needs a consolidated approach Australia-wide, doesn't it?
Absolutely. And I think we mentioned it before, I think the Treasurer has committed to a review of the Reserve Bank and monetary policy, and there's no doubt that the incoming Labor government needs to, the federal Labor government needs to look at housing on a national scale and how they can bring, states and territories into line with a national policy and framework moving forward. But that's my thoughts. I'm sure there's challenges with that, Roy, as there is with all of this stuff. Hey, that's all we've got time for today. It's been fantastic joining you on RJ Sanderson TV again. Roy, what are you looking forward to for the next month, or what's the outlook? We've spoken about how things are sort of sitting precariously at the moment. What are your thoughts? Yeah,
I think we're going to have more of the same for a little while, and it'll be interesting to see where the consumer confidence goes going forward, given we have a new government federally. So it's going to be interesting times.
Roy, thanks for joining us on RJ Sanderson TV. Thank you at home for watching. This has been episode 4, 2022. Thanks for watching.